All right, I got 10 o'clock straight up on the hour, ready to get this thing started. I know everybody's on this and wanting to learn some great stuff. Look, here at VAREP, we are absolutely blessed to have you guys part of this. Glad you're logging in. I know PrimeLending has been a sponsor for a long time. They have some great information to share with all of us. So just some housekeeping items real quick. One, if you got a question, please raise your hand. We'll stop the presentation, ask the question, get your questions answered as soon as possible. Also, Jesse just made the mention, it will be on the members area on the VAREP website under the VARAP section, so you'll be able to go back and reference this information again. So, man, again, I'm really glad you guys are here. It's going to be an awesome informational, lots of awesome information you're going to receive today. So with that being said, I want to introduce LaTanya. She's going to take a minute to talk about her relationship with VAREP, what that looks like, and then we're going to get right into the speaker. So LaTanya, let's hear what you got to say, my friend.
Absolutely. Well, thank you so much, Scott, for having us. We really appreciate the opportunity. I'm LaTanya Donaldson, and I oversee multicultural lending for PrimeLending, and I could not think of a better place that I would rather be right now and sitting here, because to your point, Scott, we have a lot of information that we want to share with your member base. And I think, you know, my wish is that everyone walks away with something that makes them stronger and makes them more knowledgeable to go out and provide sustainable homeownership opportunities to our VA community. You mentioned our relationship. Yes, we have been partnering with VAREP now since around 2012. You know, we started out kind of on the ground floor with the organization, and has been phenomenal and just, you know, amazing to see this organization grow the way that it has. And I'm convinced that, you know, under the leadership of Destin and Sohn and, you know, the board, you guys you have been doing phenomenal things, and you will continue to do phenomenal things for this also important community. So with that, I am going to turn it over to Darren Houston, our production manager, who hails from the great state of California, specifically San Diego. So I will allow him to introduce himself, and we'll get this going.
All right. Good morning. Good morning, everyone. Hello. Greetings from San Diego, California. I'm Darren Houston. I'm a new member to VAREP as of 2021. So I'm excited to help out here in San Diego on a local standpoint and be involved in as much as I can here on the board or in the local chapter to help grow the membership and help grow awareness. I'm 25 years in the industry, 26 years in the industry. Mostly my branch manager, Scott Beyer, and I run a team out of Carlsbad, California, covering San Diego. We do 40% of our business is new construction, 76% of our business is purchase business. So we're focused on putting people in homes primarily for the first time. Excited about what we can share with you here today, and happy to answer any questions as we go along the way. So Chris, if you don't mind, I just want to talk about and remind everyone about some basic stuff that is basic to maybe us in the industry every day, but needs to be brought to our awareness again. Some of the benefits of VA home loans, as you can tell, no down payment. We tend to like to pay for our lender fees for all of our veterans and active duty persons. So, you know, we're trying to minimize the cost as best we can, providing flexible terms, your 30-year, 15-year fix, your 5/1 ARMs. And ARMs have been, you know, on the rise again, or at least in the conversation about how to minimize your debt service over a short period of time, especially in this rising market. As you all are familiar with the income qualifications, residual and debt to income rates, there are two different factors that come into play with VA that doesn't come into play with FHA or conventional financing, which makes it much more flexible and more fluid in terms of access to credit and allowing more people to qualify with maybe possibly a higher debt to income ratio, or looking at that residual income to offset any type of higher debt to income ratios to allow people to purchase more home. You could also look at the credit qualifications flexibility, 2-year period after a chapter 7 and 12 months of satisfactory payments after chapter 13. You compare that to conventional, where you're waiting 2 years for an FHA loan or 4 years for conventional loans. So, those that need the purchasing power now after going through some traumatic financial troubles, as long as they've reestablished themselves, it's easy to get back into home ownership. Chris, would you be so kind to go on to the next page? I think for many of you, especially in some of the higher balance states, the thing that you can really take advantage of as a veteran is you're doing, loan amounts up to $1.5 million. Granted, that's going to be a very large payment, but it still allows you to get up to some higher price points in some of the markets where the sales prices and the average sales prices are quite high, such as, say, Hawaii, such as San Diego here. And then one of the other unique features that we offer for VA loans is their renovation product. And that's allowing people to increase or take an old inventory home and remodel it or reface it and make it up to par or standard to today's standards. So there's a lot of exciting information and new changes not new changes, but activities that are happening within VA that most people aren't, maybe not be taking advantage of or not utilizing to their fullest. And as many of you are sales agents, real estate sales agents, some of these things are going to help to increase, your services to your client base. Chris, would you share the next slide? I want to talk about a particular unique product that we have here at PrimeLending. It's our lock and shop program. And it allows consumers to shop for 45 days. It's a 75-day lock, put it that way. You've got 45 days to identify a property and then 30 days to close your escrow. And so, as Chris will speak to the market here shortly, as you see the markets changing and interest rates changing, for example, with inflation pushes now, customers can lock in an interest rate. In the event that rates are going up, they're able to secure that term and that rate at the lower term. If rates are dropping, we also have the ability to relock at the more advantageous rate for the consumer, trying to provide the best service that we possibly can and options during times of change. In 2020 and 2019, we saw very flat and low interest rates. And at the end of 2020, things are starting to move. Here we are in 2022, and we're at a higher peak than we were the last 2 years. And so now is a great time, especially if you have persons buying new construction where the construction times are not quite set. Many times people can't lock in that rate or do that extended rate. Lock is very expensive based on the time of the lock. So this will give some people some advantages in the market. For real estate agents, it gives you a peace of mind, gives your client a peace of mind that, that they can take their time, so to speak, and to look at properties, even though it's very competitive. And then, later as we do some question and answers, I'll be happy to answer some of the day-to-day nuances that we're seeing in the market. I can speak to this.
Hey, Darren, real quick, we do have a question come back. Chris, can you go to one screen prior to this? Sure. One slide prior to this. The question comes from Brian Phillips about the $1.5 million max loan limit. Is that the max loan limit for VA, or is that the max loan limit for PrimeLending?
No, that's for VA. So your manufactured homes, you're looking at your conforming loan amounts are going to be $548,250. In your high balance communities, they're going to be $1 million and $1.5 million. And so that's for purchase transactions, and for high balance refinances, they're at the thresholds are at 700,000, 1 million, and 1.5. So yes, your maximum VA home loan is going to be $1.5 million.
So real quick, can you expand on that just real quick on, so if a veteran wants to buy a $3 million property, can they use their VA home loan?
Up to 1.5, they would have to come in with the difference, yes.
So is it 25 of the difference? So the 25% of the 1.5 million, or is it, they have to bring in 1.5 of their own money?
They have to bring in 1.5 because the maximum loan amount is going to be 1.5. So in the event that, let's say you have a purchase price of 1.5, you're looking at 100% financing. At $2 million, they're going to have to come in with 500,000, and so anything above, $1.5 million, it might not be, if they don't have the down payment, you're going to be limited to $1.5 million. So anything above that, then you're going to want to look at possibly some conventional financing, because then you're looking at larger maximum loan amounts, 2 million, 2.5 million loan amounts in relation to 80% or 75% loan to value on the purchase price. So at $3 million, if the veteran had the ability to put in down payment, they might be better served looking at a conventional loan at an 80% loan to value versus making the difference of a $1.5 million loan and a $1.5 million down payment on a $3 million property.
Got it. So some more questions are coming in. Kathy Bombush asked, if they're buying a $2 million property, can they get a second mortgage for the 500,000 and do 100% LTV?
Yeah, that's a great question. And secondary financing is not permitted for VA home loans, regardless of the type of property. So subordinate financing is not permitted. Seller financing is not permitted, unfortunately. Got it.
Okay. Another question from Yvette. You might want to speak to this. Yvette Hitchens. She's asked a question about ADU. I'm assuming that's
an accessory dwelling unit.
Yeah.
Yeah.
Can ADU be added with the renovation loan?
It can be, yes. We have a renovation department that specializes in strictly renovation. So anytime I would originate a VA renovation home loan, I would source a loan and then pass it to our VA dedicated group. And so, Yvette, all of our contact information for Chris, myself, and Latanya are in the slides. So if there are specific case scenarios, happy to share that information and get the right parties to answer your specific questions. Yeah, but we can.
There are more things are coming in about this loan limit. You may want to talk about the Blue Water bill that was passed in 2020 and how that affects these loan limits and what that looks like. There's just a lot of conversation here about the Blue Water bill and limiting and making the loan amount unlimited. So can you speak to that, or do you want to get back on us on that?
Well, I haven't seen the Blue Water Act change our actual guidelines. And so, and Chris I wouldn't put this on Chris in terms of answering that, but the agreements that we have as a company with the Veterans Administration, at this point, this change for unlimited loan amounts has not been affected. The numbers that I'm providing you are as of September 2021, and that's what we're going and using for 2022 so far, until we have a corporate change with our policy on loan limits. So as it stands now, it's not in effect for us at PrimeLending. Not to say that it's in effect somewhere else, but typically, if it's available to other large institutions, we are going to also offer it at the same time.
Okay, great. So that's all great news. So I'm sure all their contact information is going to be provided to you guys at the end of the deal. If you want to email them directly, talk to them directly, they can surely answer those questions. So Darren, it looks like that I've caught up all my questions on my side. So if you just want to continue on, that'd be great. Thank you, sir.
That's right. So I think the last slide, Chris, was talking about our lock and shop program. Here in San Diego, I'll speak to San Diego. it's a very competitive market, and properties are moving quickly. They've been moving quickly in 2020. You've all seen that. And our average sales price for San Diego County in specific is a little over 600,000. And if you think of coastal properties, you're at $1.2 million, $1.3 million on an average sales price. And so what we're seeing, what is very unique, and this is a part of the education process for myself with my business partners, my real estate agents that I partner with, the home builders that I partner with, is to when a veteran is purchasing a home, their offer, their financing is as solid as a conventional program. We've had listing agents, I've seen listing agents want to write in the offer, in the listing agreement, that VA home loans are not acceptable, that it must be a conventional purchase. And so we're really, the information or the understanding of what a VA home loan is really needs to be permeated throughout the real estate industry in terms of it being a complete viable and loan tool and product for people to take advantage of. And it's equally as effective and equally as important as a conventional or an FHA loan. So I think many people want to steer away from, offering a VA, making a VA offer or accepting VA offers. And it's really, it makes no sense, really makes no sense. So there we are. Chris, I think that's the last slide for talking about some of the basic product information. But I'm happy to, like I said, answer any questions here in San Diego. So we cover, my office covers almost all the way to Corona, but we cover Riverside County, South Riverside County, Murrieta, Temecula, down to San Diego, because there's a large new construction community and resale community. So, anything, if you think Southern California all the way to the border, give us a call, reach out to us here, and happy to assist. And you should be able to see us and be myself involved in the local chapter here in San Diego. So yeah, happy to answer and be a part of this. And thank you for the opportunity.
Okay, Darren, great. I don't think I have any questions. I know there's some stuff. I mean, Yvette and Mr. Schmidt, if you want to, here's Darren's contact information directly. You may want to reach out to him if you have any further questions on what this looks like for you, and you want some more clarity on your questions, feel free to give Darren a call. So
yeah, Georgia, I agree with you. If you're not accepting, in a marketplace like where you are there, Colorado Springs, you would be silly not to entertain and not to, want to warrant a VA. In our marketplace, it's not the percentages of VA home ownership is not as great as conventional and FHA products. So each market is definitely different, and absolutely in your marketplace, it's a very strong product. So keep at it.
Hey, Darren, I don't want to interrupt. I want to make some clarity. If we go back to your very first slide, and I want to talk about the income qualification. This is an important piece, right? I want you to explain to them if you can expand on the residual income and what kind of impact that has on qualifying a VA borrower. This is a key piece. I just want our participants to understand that this is the piece that will pull your VA home loan through more than anything. So please expand on that, Darren.
Yeah, so thank you. Great question. So the best way to do it is, I guess, to compare it to a conventional loan. And so when you have residual income, so let's say a service person has a housing allowance, for example, that's non-taxable. So any non-taxable income that a service person receives, so there's base pay, and then there are active duty pay, and there's different types of scales of pay that are non-taxable. So when you look at a service person's W-2, normally that's lower than the actual income received. And so what we look at in terms of residual income is we take all of the non-taxable income and we gross that income up 125%. And so that increased income is allowing borrowers to then afford more home or have more affordability. So, and we compare that. There's two different things that we look at. We look at, we look at qualifications of loans under residual income, and we look at it in terms of debt to income ratio. Now, all of our loans, every mortgage company runs an automated system to approve their home loans. And however, these two factors of the debt to income ratio and the residual factor can push someone over the edge to qualify that may not fit the actual square box, so to speak. However, these are advantageous to help borrowers, qualify for more home and actually qualify for the home that they're looking at, that they're in contract with, they're wanting to be in contract with. So it's an analysis to help consumers really take advantage of their entitlement, this isn't the way conventional or FHA is looked at or qualified. It's very unique to VA home loans. And so, many times you have the same borrower looking at, let's just say, 5% down with a VA home loan or a conventional home loan. And that residual income or that higher debt to income ratio using a VA home loan is going to allow them to purchase the property where they wouldn't do it or qualify, so to speak, under a conventional loan. So it really is a powerful tool that is every day for us internally when we're doing analysis of credit and analysis of the qualifications. However, if you're increasing someone's income 25%, let's say that half of their income is $5,000, if you're increasing it 125%, that's a big number. That brings your debt ratio down. That increases your buying power. There's a lot that you can do there. Yeah.
Sorry, I didn't interrupt you. I just wanted to say that was all great information. I want, if there's any other questions that are coming Darren's way, just let us know. But Darren, great job, man. We're about halfway through this. Let's kind of get Chris involved now and talk about his. If you just introduce Chris, Darren, that'd be great.
Absolutely. So Chris he's joined PrimeLending back in 2006 as a vice president. He was promoted in 2012 to a senior vice president. His current position is the executive vice president of capital markets. And so what that means is he's heading our secondary market. His responsibility is to manage the interest rate risk of residential mortgage pipeline and the profitability of our sales executives here. With over 25 years of mortgage experience, Chris has served in a variety of positions, including those in both secondary market and servicing analytics. Prior to joining PrimeLending, Chris ran the secondary market group for both retail and wholesale companies. As a mortgage originator, we're looking at interest rates every day. We're looking at interchange of interest rates during the day. We're listening to, what's happening in the market. But Chris is doing the analysis, and he can share with you what we look at as an entity, as an organization, and give you some real good insight as to where we are in our economy and from a mortgage standpoint. So without further ado, please welcome Chris Caudry from our secondaries market department out of Dallas.
Thank you, Darren. Yeah, like you said, I focus on capital markets. I focus on interest rate risk. And so when I get into product details, I'm getting a little bit out on a limb, but I want to circle back real quick on the loan limits. VA will allow you to go higher than 1.5 million in certain markets. PrimeLending does have guidelines up to 1.5 million. We can, by exception, go over 1.5 million. You have to look at the guarantee amount and the down payment. And so, Darren, what we can do is we can circle up and maybe come up with a flyer or something that we can send out to the folks so we can clarify that. But so there is opportunity above 1.5 million on an exception basis at PrimeLending.
Wonderful.
So
Thank you.
Yeah. So what I want to do is I'm going to go over just some economic data. And what I'd like to do is, what I'm going to do is give you my opinion. And so, because just giving economic data can be kind of boring. So I'm going to give you my opinion. So I was saying that these are going to be my opinion, not that of PrimeLending, not that of Plains Capital Bank or a holding company, HTH. They're my opinion. Hopefully it's a little bit more fun than just me reading off numbers that you guys have already heard in the news. And I'm going to start with this graph. It's unemployment. You know, the economy was running along hot. Employment was great before the pandemic. Employment rate was at 3.7%. Obviously, everything got upended in March of 2020. Lots of people were laid off. Unemployment went over 8%. But really, within a few months, people started rehiring. And if you fast forward to today, we're already down to 3.9% unemployment. So we've recovered significantly a lot of the job losses that happened during the pandemic. And this is the employment rate that's published. It's called the U3. There's another employment number called the U6, and that includes people that are underemployed or disgruntled. It's really, in my opinion, probably what most people more consider what an unemployed person is. And I thought that number was going to really show some telling information, because with what happened in the pandemic, I think you had people making life decisions. You had people deciding whether or not they wanted to continue doing what they've done for a living going forward. You had people moving geographically, they're moving from cities to smaller towns, making all kinds of decisions. And I thought the U6 unemployment number would show something different, but if you pull those numbers up, it was 6.9% before the pandemic. And it's come back and it skyrocketed, but it's come down to 7.3%. So you really didn't see a divergence between U3 and U6 unemployment, even though you did have a lot of noise with people moving locations, changing roles. So it's really a strange employment market. The numbers look great, but there is a subset, especially in hospitality, I think, where there's still some dislocation. This slide just is a continuation showing, employment looks really good. If you look at the graph on the left, whether it's quits, hires, or openings, they all look really good. If you're going to quit your job, you probably feel good about getting another job, or you already have another job lined up, and quits are above where they were before the pandemic. And then if you look at the job openings, and if you look at the graph on the right, there's 1.5 jobs for every job seeker. So the jobs market is good. There's opportunity. This is actually also causing wage growth, which overall is a good thing, but could spill into inflation, which we'll talk about. So overall, wage growth is at about 4.3%. Excuse me, 4.5%. For those folks that have actually switched jobs, wage growth is at 5.3%. So good news, just a story that the job market's strong. But again, with that wage growth, we got to start thinking about inflation for, I don't know how many months we've heard transitory. Before the pandemic, I never heard inflation referred to as transitory. And so all of a sudden, inflation, a year and a half ago, inflation is transitory, meaning, the Fed had to come in and really be accommodative. And they thought that these moves would create inflation, but they would go away in a few months. Well, I don't think inflation's that transitory. And I think the economy and I think the Fed, if you've heard them recently, has come to agree that, and they realize inflation's now a problem. If you look at the CPI and PPI that came out last week, that was, continued to be high. CPI 7%, PPI 9.8%. So you're seeing inflation rates that are mirroring what we had in 1981, 1982. So inflation's getting pretty hot. And as somebody who's watching the bond market, the bond market does not like inflation. So we're watching that closely. And as we talk about in a few minutes with the Fed, they're going to take actions to try and cool that off. I'll stop here just real quick. And like we did with Darren, if you guys have any questions, more than happy to have Scott. If you want to interrupt me and ask any questions, I'm happy to stop. But until then,
I don't see any questions coming in. I think the information you're giving is great. May not be creating any questions. So at this point,
okay.
No questions.
Good deal. I think everybody on this call is probably, for the most part, either realtors or mortgage bankers or somewhere in the market. So you guys know this better than I do. But the housing market just absolutely on fire. So whether it's existing home sales, new home sales, you look at the inventory numbers, it seems like for the since 2017, every time there's a presentation I hear, inventory is at an all-time low, and it just keeps getting lower, even though you don't think it can get much lower. And you've got a lot of things causing this issue. If you go back to pre-financial crisis of 2006, household formation for decades in this country was about 1.2 million household created per year. And then the financial crisis just really disrupted household formation. You had people delaying normal life changes. People were delaying college, were not getting married. The story of the millennial leaving college and moving into their parents' basement. I think there was a lot of that actually did go on, in 2008 to 2015. Our household formation post-crisis of 2008 until 2015 was like 800,000. So it was a serious drop, yet our population trends kept increasing. So that created a huge pent-up demand in housing. We talked about it for years, 2017 and 18. I gave presentations about this wave that's coming. Well, guess what? It's here. Millennials are the biggest, they're the biggest generation group living, and they are now, and I forgot the exact number, but they're, on average, they're 35 years old. They're having those life events that are triggering them to want to buy a house. And you just see massive demand and very little supply. Again, with everybody on this call, you know that better than I do. And then home price appreciation, it's very aggressive. And I went back and looked at several slides over the last year. And I remember one in 2017 where the graph would, halfway through this graph, it looked just like this. And then the line started migrating back down to a 2% per year increase. And so every year we keep expecting home prices to normalize to an annual growth rate, HPI of 2%. But what have we seen? We've seen low rates, the wave of demand, just pushing home prices higher. And as we saw last fall, Fannie and Freddie, they increased their loan limits by like 18.5%, which mirrored the home price appreciation. So you see home prices just really escalating, and Fannie and Freddie stepped in and increased their loan limits in lockstep. And then on the supply side, the struggles the builders have had, not only in the since the pandemic, but, since 2017, 2018, and you talk about the 3 Ls, lumber, land, labor, laws, there's headwinds in all those areas. And I wanted to share this graph. The graph on the left just shows the shortages, whether serious or minor, on all the different things required to build a house. Appliances on top, up to 95% challenge and serious shortages, all the way down to concrete, which is the best performing available product for builders. And that still has 43 to 44% shortages. So they're challenged with many headwinds, including labor, including laws that make it difficult to get the permitting. So I think those headwinds will persist. But when you look at the graph on the right, post 2008 crisis, there was just a plummeting of homes being built in our country. And it's slowly inched its way back up. If you go back 2005, 2006, we were building lots of houses. But if you go back a few years before that and you look at a 10-year average, it was 1 million homes plus or minus. And so we're kind of getting back to what I'd call more of a longer term mean, probably still a little bit short, but we're seeing single family construction inch its way back closer to what it's been long term. And this is just an example, lumber just absolutely went through the roof last summer. It started to normalize, but guess what? It's on its way back up. Anecdotally, I went to go replace my fence last April, and I went to go price it out, and it's like, oh my gosh, lumber is so expensive. I immediately went into the stain section of Home Depot and decided to stain my fence, and hopefully can limp that out for a few years. But lumber is just a great example of just absolute skyrocketing
So you're
prices.
saying there's no shortage of stain or paint? Is that what you're saying?
Well, there wasn't, thank God, at least last April. But you know what? It's funny. It's whether we're talking about houses or lumber, or you're talking about cars, and you go on and on and on. Since the pandemic, it seems like across the board, there's demand through the roof for everything, and yet there's a supply hindrance and supply chain issues for everything. The other thing that happened to me last spring, I got in a situation where I had to go get a new car. And man, I normally buy a car that's 1 or 2 years old. It's almost new. It's certified pre-owned, whatever. Oh my gosh, that was painful. So you hear those stories about, you know, used car prices going up and the availability. Well, I know last April there was nothing on the lots, and it's just another example of supply demand offset. It's in housing, it's in cars, it's in a whole lot of things, and that leads to that inflation that we were just looking at. So, you know, let's jump forward to, you know, let's forecast a little bit, look at what we think is going to do, you know, what's going to happen going forward. These are the Mortgage Bankers Association numbers, and I'm going to use that as a guide. You know, I was going to jump down new home sales, that third line. If you looked 2022, 922,000, then you jump up to 1 million. That's that number where I feel like at least new home sales and new construction, it's getting closer to a long-term mean, a long-term average, but there's still a little ways to go there. And we still have this huge offset in supply and demand. And it's who knows how long that will persist. And then, you know, for mortgage folks, we'd be interested both in the purchase and refinance origination numbers below. But, you know, if you're a realtor, that would these purchase originations will correlate very closely, not exactly with the cash buyers, but will correlate closely to existing home sales and new home sales. And, you know, if you look purchase originations, the MBA is expecting that's about a 7% increase to 1.7 trillion. So purchase business, given the supply demand constraints and really the demand, purchase business is expected to expand this year. So, and into the next few years. So that's good news. GDP, obviously, you know, economy got crashed in 2022. We bounced back hard last year, and then expecting good growth this year, and then really to normalize, and then back to what I'd call less than spectacular 1.9% in 2024, but near term looks very good. MBA's inflation numbers, I disagree with. I think inflation, I think the Fed has a very difficult job. They've been over accommodative, which has been great for interest rates, which is very good. But the Fed doesn't want to get themselves into a situation where they're chasing inflation. An analogy is if the economy is like a fire you're using for warmth, you don't want it to get too hot and get out of control. Well, you know, we're starting to think maybe it's getting too hot, yet they're still doing quantitative easing. They're still pouring gas on the fire to, you know, through probably March. And so I find that I think the Fed's going to be chasing inflation well beyond just, you know, 12 months from now. So I disagree with this unemployment number here, but the MBA has got a lot more smart people than I, and a lot of economists who are thinking that inflation would be back down to 3% this year, but I'll bet against that. Unemployment numbers, we've already talked about. Those actually look really strong for the next several years. And then we'll talk more about this, but the Fed funds rate, the rate that the Fed changes does not necessarily correlate to mortgage rates, but it does impact interest rates in general. And, you know, everybody was convinced the Fed's going to have to raise rates 3 times this year, because the economy is probably running a little too hot. Well, if you go look at the Fed futures market, they've got that's kind of forward looking. You know, that's now indicating there's a higher chance of 4 increases in rates, not 3. So if that's the case, we'll see a Fed funds rate, which is the short end of the curve, not at 7/8 or 87 basis points, as it shows here on the Fed funds for 2022, will be more like 112 basis points. The next line down, which is much more correlated with mortgage rates, is a 10-year Treasury. And, you know, that's really shot up in the last 6 weeks. You know, we were in the call it 250 handle December 1st, and we hit, actually we hit 150. We hit 190 overnight. It's back down to like 184 right now, but we've seen a real run up in rates. And I think it's because the market's looking at what the Fed's going to have to do this year. And so we're starting to see yields increase. I do expect the 10-year to definitely cross over 2% this year. And I think, 2.25 plus or minus is where we'll see ourselves by Q4 this year. And that will result in probably in a little bit higher mortgage rates. They're calling for mortgage rates at 4%. I think that's right. I think we're going to be looking at 4 to 4.25 over the next year and a half. And then depending on how inflation goes, those levels could hold. If inflation continues to run out of control, you'd look at 23 and 24 and probably ramp those up a little bit, but hopefully they can get that inflation under control. And again, this is just a repeat showing that and I'm focusing on that purchase line, the green bars, and that's just showing graphically that they're expecting purchase business to grow in the coming years. And so that's good news. It's good news for realtors. It's good news for mortgage bankers. Obviously, if you're a mortgage banker, you know that with rates going up, your refi business is going to go down, but it looks like purchase business should be very strong over the next several years. So, that's a high level of what the average economist thinks. And I think this right here is likely to be true. We're going to see purchase business expand. We're going to see an increase in rates, but nothing substantial. But I'm in charge of interest rate risk. And so I don't want to scare anyone, but I'm going to show you, as I'm looking at risk, I always look at what's called the tail risk, which is the unlikely, but one scenario that could happen that could disrupt interest rates and potentially disrupt the mortgage market. And so not scare anybody, but this is what I'm looking at as a tail, very unlikely, but tail risk. And so I'll go through that real quick. This is a spread of more pass-through mortgage yields, or representative of what mortgage yields are, and that white line and the red line is treasury yields. And what that just shows is a very tight correlation. And it's hard to tell in this graph, but it starts to diverge a little bit starting last December. And so, treasury rates are up 35, 40 basis points, but mortgage rates are up over 50 basis points. And so what's going on there is that spread between treasuries and mortgages are widening out. What some people say mortgages are underperforming, or the rate upon which mortgages are going up is faster than treasuries. And the reason for that is the market sees what the Fed has said they're going to do, and that is they're going to start taking their foot off the gas on MBS purchases. And so what does that mean? Well, all that means is they're taking demand out of the market. When you take, it's that Econ 101. If you weren't like me and you stayed awake during Econ 101, supply demand, that impacts everything. If there's less demand, prices are going to go up. Prices are going to go down, but that means yields are going to go up in the bond market. And so that's causing those mortgage yields to widen out in anticipation of the Fed to be less accommodative and buying less mortgage-backed securities in January, February, and March of this year, and frankly be wrapped up by as early as March to stop buying new mortgage-backed securities starting in April. And so that's causing headwinds in mortgage rates. We already talked about this. This is that dot plot that just shows where the Feds think rates are going to go. If you look at that, the Fed's indicating they see three rate hikes this year. If you go to the futures market, this is actually a couple of days ago, it's actually shifted even more. But if you go into the futures market, the market is betting there's at least a 60% chance that they're going to raise rates 4 times this year. Given that we have very important off-cycle elections this October, my bet is they're probably going to only raise 3 times. There'll be political pressure especially from the Democratic side, not to aggressively raise rates, because that could have a detrimental impact on GDP and the economy overall. So markets betting on, it's like up to 65% chance of 4 rate hikes. Given the elections this October, I'm going to bet on 3 rate hikes. so you've got, the Fed's already announced they're going to slow down the quantitative easing or the buying of mortgage-backed securities and treasuries. You've got them signaling they're going to raise rates 3 to 4 times. And then I don't have a slide for this, but they've also opened the door to potentially reducing the amount of bonds they hold on their balance sheet. So right now they're adding gas to the fire. What they're talking about when they're saying they're going to reduce their balance sheet, that would be like pouring water on the fire. And so I'll be listening very close, and the minutes of the Fed meeting next week will be very important to see if they start giving indications they're going to start reducing their balance sheet. So like I said, as of today, they're adding to it. They'll stop doing that in March. If they start early this year, reducing their balance sheet, that could be a headwind for mortgage rates. And so we need to watch all those things. So you've got a kind of a triple whammy of things the Fed's doing to try and combat inflation. And the reason why I'm watching that closely is if they get too aggressive, you could see yields really go up. And this graph is from the Atlanta Fed. And I like it because it kind of just simply takes 3 things that really summarize affordability in housing. It's taking the average income across the US, it's taking what the average interest rate's doing, and then it's also looking at price changes in housing to see how that impacts affordability. Well, you can see since 2020, the last 2 years, man, HPI or home price appreciation has really gone through the roof. And so it's already creating affordability issues already. And so if you were to take this graph and then you were to pull that line down further on the far right, because interest rates go up significantly, you're going to become to where affordability becomes such an issue that borrowers are going to have to reconsider, what can I afford? Because if I call Darren today and he says I qualify for, and I can go buy a $500,000 house, and we're looking at a 3.5 note rate, just as an example. And then I call him back next month and he's looking at 4.25 because the market's gone up based off these concerns. I'm not looking for a $500,000 house anymore. He's going to tell me I got to go look for 425 or whatever that is. And that's, except for the small percentage of cash buyers, that's systemic. And so this is a tail risk I look at. I think the MBA is right. I think we're going to see good sales volume this year. I think we're going to see a lot of purchase business in the mortgage-backed securities, in the mortgage-backed market. But I'm watching this because I don't want rates to go up too much too fast, where it's starting to impact the conversation that the borrower has with Darren or another loan officer. Because if that starts happening at a systemic rate, then you're going to see a lowering in expectations on the consumer and the buyer who's been in a buyer's market for I don't know how many years now, who thinks they're going to get, whatever, $700,000 for their house. If every borrower is going through this challenge because rates increase too quickly, every seller is going to have to rethink, okay, well, maybe I can't sell my house for $700,000 now, and maybe it's $650,000. And so I'm just worried about systemic liquidity. If the Fed has to go too quick, causing rates to go up too fast. Now that's a tail risk. I don't think that's going to happen. I want everybody to focus on, this green chart here, because I think that's where we're likely going to go. So with that, I will pause and happy to try and answer any questions that we may have.
Wow, great job, Chris. So far, no questions coming through. All I gotta say is, whew, wow, that's a lot of stuff to think about and apply when we're meeting our customers. So you guys that are on the call, this is some great information. Please take this information, share it with your client base, your industry friends, educate them, help them understand what we're ahead of. And obviously, Chris, if you have any questions, Chris's information will be available on the VAREP website in the podcast area. So with that being said, I think that this is we're getting some excellent job. Donnie says excellent job. So I think that being said, I just want to reiterate how important, sorry, I'm trying my video. how important you guys are to the mission of VAREP and what you provide to help educate our membership and our communities. Because if we just share one nugget of information with our attendees and they can change the difference or change the life of our veteran community, it's a complete win. So thanks again, guys. If you got anything to add in closing, just let me know. We'll start with Darren. You got anything to add in closing, Darren?
I thank you again for the opportunity, to be of service. Like what we do with our client base is we do a mortgage checkup or, annually. I recommend you all, as agents to partner with your mortgage partner. May it be someone here at PrimeLending or someone there local in your market, sit down and go over strategies and changes that are happening in the mortgage market to help you be more tooled for this incoming year. As Chris mentioned, it's purchase driven, and so it's just so competitive. It's just a competitive marketplace. In like, for example, in San Diego, it's days or hours that properties are coming on the market and going off the market. So sit down with your mortgage partner and help to identify some strengths to sharpen your tools and be ready for this upcoming season and year. So thank you again, and happy to answer any questions. I believe, Jesse, you're welcome to share our slides with those on the group and or post our slides to the website and to your VARAP, as you say. Happy to be involved. So thank you.
Thanks, Darren. Okay, we'll start. Chris, you got anything? Then Latanya will let you finish with and close us out. Okay, Chris, you got anything to add for
No, I was going to say thank you for the opportunity to present. I hope it was helpful. The slides are available. Darren's information is there on the screen. I apologize that I didn't have mine on there, but I'm happy to answer any other questions if people want to follow up with a phone call or an email. And happy to help any way I can, especially if we're talking about helping a veteran.
Awesome, thank you. Latanya, close us out, girl. Let's hear it.
Absolutely. Well, again, I just want to thank VAREP for allowing us this opportunity to share our information. We had two dynamic speakers here today, and a big, huge thank you for the people who took out the time to join us today, the people who want to know more. Again, the presentation will be available. I think we streamed it live on Facebook. But again, we appreciate you guys stopping by to hear what we had to say. It's much appreciated.
Awesome, awesome. Okay, look, that's the end of this. Make sure you go to our website, varep.net, go to the members area, and maybe on our VAREP section on there. Just look for it, get in there. If you got to refresh or want to hear this again, absolutely do that. But again, to reiterate what Latanya says, man, thank you for joining. We can't change the lives of our communities or our veterans in our communities without people like you wanting the knowledge. So again, from VAREP, we thank you.